Hello and welcome to another edition of RTX Chats. I'm Rusty and this is Ricky, and we're here to talk to you guys this morning about a little bit of fun stuff called loan underwriting. So as lenders, we do have to vet the project and vet the borrower before we can give a thumbs up and approve a loan. So just wanted to cover very briefly some of the things that we look at in our underwriting process. And you may have heard that lenders use a 4 criteria, sometimes known as the 4 C's of underwriting. So Rick and I are going to discuss each of those and what they mean, and hopefully that gets you better prepared when you're applying for a loan, and so that you can present your loan and your project and yourself to your potential lender. So the first one up is collateral. Collateral is by far the most important thing. And the old saying in real estate, the most important thing in real estate is location, location, and location. Well, as it relates to lending, the most important thing from a lender standpoint is collateral, collateral, collateral. So this is the project itself, the fix and flip project or the fix and rent project that you're working on. And the reason why it's so important to a lender is that it provides an insurance policy, if you will. If the loan doesn't perform, if the borrower doesn't perform, it gives the lender the opportunity to obviously put the lien on the property and potentially take back the property in the worst case scenario. So the lender really needs to understand the property itself, the ARV, the after repair value. Does the repair value match the scope of work for the repair budget match the scope of work? Is it in a reasonable time frame? And then a common calculation that you probably already using is, we want the project to have the purchase price to be 70% of the ARV less any repairs. That's the max you should be paying for the property. We want you to be successful, and if your numbers don't provide you a successful profitability opportunity for profitability, we're going to tell you, and we're probably not going to do the loan. So make sure you've got your numbers dialed in, and collateral, collateral, collateral.
Yep. And Russ, I'm going to touch on the second C of the 4, which is character. And you already mentioned how important the collateral is, but not much behind collateral is character of the borrower. And, one of the things we look for is honesty, integrity, and experience and their backgrounds. And so when we're trying to, ascertain whether or not somebody's honest, when we're asking you for information up front, we try to validate what you're saying is actually truthful, and that you're telling them not just partial truths, but whole truths. And even if it's a bad thing in your background, as long as you disclose it, then we know you have some character. And then we really try to get to know our borrowers, newer borrowers. Obviously our experienced borrowers, we have a relationship built up, but a newer borrower, we try to just, get to know them up front and ask them some questions about their backgrounds and that kind of thing, and try to ascertain their character. So if you're a borrower, knowing that, you might want to just, when you're trying to get a loan, just be honest and forthright from the beginning. And I think that goes a long way. Collateral still matters the most, and then your character is right there with the collateral. Your character says it all. So
yeah, well, I think a way to look at it from a borrower's perspective is, treat your interaction with your lender just like you would for a dream job, an interview for a dream job. Put your best foot forward, be available, be timely, be communicative and transparent. And we want to lend to folks that we get to know, that we like, and that we ultimately can trust. And you should be looking at your lender in a similar fashion.
Yeah, agreed. Good point, for sure.
All right, number 3, capacity. So capacity can mean a couple different things. The first thing that that it means to me is, does the borrower have the capacity to participate in the project in the form of liquidity and cash? You know, I know that there are lenders out there that supposedly advertise 100% financing on these projects. I've yet to see one that actually does do that. So in most cases, we're going to lend, up to 80–85% of the purchase price. And that means the borrower is going to have to bring some cash to the table to close. And the borrower also needs to have some cash reserves available for holding costs and some rehab budget overruns. So if you don't have the cash liquidity available to take a project down, about your only other option would be to bring a third a partner that has cash that can bring some money to the table, or in some cases you might have some additional investment property that you have high equity in, and sometimes that additional collateral can substitute for not having cash liquidity.
Yeah, oftentimes these, especially newer borrowers, do see the advertisements, where, hey, no money down and 100% financing and that kind of thing. But at least from our firm's perspective, we definitely want our borrowers to have a little skin in the game, something that keeps them focused on the project and have a little at risk. And so cash and collateral and their capacity, which is the third C that you're mentioning, Russ, really does matter. I agree.
Yeah,
and then, go ahead.
Yeah, as I said, the other thing related to capacity, we deal with both experienced and new borrowers, and it's important from a capacity standpoint to align your experience with the project. So it's probably not something that we'd be comfortable with lending to a brand new borrower who's never done a deal before, if they're doing a full gut rehab or maybe a brand new construction project. So if you're a newer borrower, get your experience with lighter rehab projects so that your experience level is aligned with the size of the project. So, and again, if you don't have that experience, it's often beneficial to bring an experienced partner to ride along with you and show you the ropes.
So let's just move on to the 4C, if you don't mind, which is credit for the borrowers. It's at the bottom of the list, but it's still important. It's on the list. And the 4C is, what's your credit history? And why do we care so much about credit history if we've got a large, substantial collateral to back our loan? You might ask yourself that. Well, one is if you've got a bad credit history, it's an indicator of how you might manage your finances. And on these projects, if you're a poor manager of managing your finances personally, you might be an indicator of how you might manage your finances on the project. Since we're dealing with hundreds of thousands of dollars on a project, we want to make sure that we can get comfortable that you can manage your own finances fairly well, so that you manage the project well itself and use the funds, as designated. So, knowing that you're going to be looked at, your credit's going to be looked at. It's not scrutinized and it's not a key determinant in getting approved for a loan, but it is an indicator. It is a consideration. It does make the list. And for any hickeys or any background problems on your credit, you may want to know that the lender is going to look at that and probably ask you. So you might want to circumvent that and say, hey, look, when you look at my credit, I ran into problems X time ago, and what happened behind that was this, and be proactive and explain what you think they might see on the background of the credit check beforehand. A low credit score or a mid-range credit score does not prohibit a loan approval by any means, especially if it's for circumstances that are reasonable or understandable or unique. But if it's a litany of bad credit, whether it's your own personal mortgage payments and your car payments and your credit card payments, and you can just see that you're a delinquent late payer consistently in all assets or all aspects for a long period of time, and you've never got it corrected, then that gets a little bit more challenging. So
Well, very good. That kind of wraps up an outline of the 4 C's: the collateral, the borrower's character, the borrower's capacity, and of course, the borrower's credit experience. So until next time, we wish you success in your real estate investment. If you're looking for funding on your next project, we invite you to give us a call. It's rtx.capital. You can find us on the website, and look forward to speaking with you. Thank you.
Thank you.